Okay, let's look at this exercise that we have pulled up on the screen. And this is an exercise that is related to preparing and journalizing adjusting entries. And if we look at the instructions here, it says for each of the following separate situations, prepare the necessary adjustments using let's see here, using the financial statement effects template, and then B, in journal form. So if we were doing this online, we would actually be toggling back and forth. Well, probably not. We would probably do one and then we would do the other. But in the interest of time, as far as keeping these videos as short as possible, what we're going to do in this exercise is focus our attention on the financial statements effects template, and then we'll make a separate video where we go back through and look at these exact same transactions and we journalize them. All right, so let's go ahead and then take a look at these items. And I will probably, due to space, have to kind of move the page up and down a little bit, and hopefully that doesn't bother us too much. So number one is, it says unrecorded depreciation on equipment is $610, and kind of glad they started off with depreciation, because depreciation is always an adjusting entry. And so notice down here on our little effects template, we have a balance sheet side, and then we have an income statement side. So you know, we're going to approach this from what takes place on the balance sheet, and then we're going to address the income statement. Now, for some of these items, depending on what they are, your thinking might be income statement and then balance sheet, and that's fine. I'm just going to do the balance sheet side first, so that I can go from left to right. Okay, so again, to review, it says the first transaction is unrecorded depreciation on equipment. Well, on the balance sheet, and we also need to let's see here. I don't see this here, but basically, if something has gone up, I'm going to use a positive number, and if something goes down, I'm going to use a negative number. I don't actually see that in the instructions. Okay, so on the balance sheet then, depreciation exists as in the form of a contra asset called accumulated depreciation. All right, and so here's our contra asset. Now, it doesn't tell us that it is accumulated depreciation, but that's what it is. All right, and so we say, okay, nothing happened to cash assets. The non-cash asset, the equipment, we don't mess with that due to the historical cost principle. So we wouldn't have anything here. Liabilities have not been impacted. Contributed capital or owner investment has not occurred. However, earned capital has actually gone down because the net value of this equipment has gone down by way of accumulated depreciation. Right? So let's just say hypothetically that we had $10,000 of equipment here. We still have the $10,000 here. We just don't see it. And then the $610 effectively reduces the net asset value on the balance sheet to whatever that would be, $9,390, right? So because of that, on the balance sheet, we would say that owner's equity, which is a better way of saying this, overall equity has gone down by $610. Okay, over on the income statement, we have no revenues here, but we do have depreciation expense, right? And And so we'll see this when we get to the journal entry exercise, but this expense and this balance sheet entry over here would have gone together. So expenses have gone up. That means that net income goes down accordingly. All right. The second item that we have right up here says, on the date for preparing financial statements, an estimated utilities expense of $390 has been incurred, but no utility bill has yet been received or paid. Okay, so let's go over here to the balance sheet. We haven't done anything with cash, nor non-cash assets or contra accounts. However, we have an accrued expense. All right, so we're going to increase that liability by $390 because liabilities are recorded when incurred, not when paid. So our liabilities go up by $390, and also earned capital is going to go down. It has to, because if we think about our accounting equation of assets equals liabilities plus equity, well, if liabilities got bigger and nothing else happened, well, then equity must get smaller by default. Okay, so over on the income statement, we would recognize utilities expense for $390, and that would make net income, in fact, go down by $390 because we don't have any kind of revenues to offset. It's just utilities expense. It's an operating expense. All right. Number 3, on the first day of the current period, rent for 4 periods was paid and recorded as a $2,800 debit to prepaid rent and a $2,800 credit to cash. All right, so let's think about this for just one moment. As I look back up here, there's actually not any indication of whether this is a monthly adjusting entry. They don't tell us that, but that is how it is supposed to be done. We are supposed to make adjusting entry on a monthly basis. Okay, so I want to go back to then, with that in mind, I want to go back to number 3, and so we've paid $2,800 in rent, and so we have a current asset called prepaid rent. All right. Now, what we're saying is that 1 month of that rent has been exhausted. So we have a lot of things going on here. We don't have to do anything with cash. That was already done in the past, right? It has already occurred. However, what we do want to recognize here is that we have the reduction of prepaid rent right here for 1 month. And so if we were to bring our calculator over for just a moment and say 2,800 divided by 4, because we paid for four periods, equals $700. Okay, so that's why I'm going to do what I'm about to do. So what we've got here is we have a non-cash asset that has gone down by $700. We don't have any contra asset. Nothing has happened with any kind of liabilities. So this is actually going to make our earned capital go down by $700 by way of the reduction of a current asset, specifically prepaid rent. Over on the income statement, we would record then $700 of rent expense, and we would then have a $700 reduction to net income. All right. I think this will make more sense to you when we do if you're struggling at all, I think this will make more sense to you when we do journal entries, but I'm just doing these in order, and then hopefully the journal entries will be a little bit easier. All right. So number 4 says 9 months ago, the Hartford Financial Services Group sold a 1-year policy to a customer and recorded the receipt of the premium by debiting cash for $624 and crediting contract liabilities for $624. All right. No adjusting entries have been prepared during the 9-month period, and Hartford's annual financial statements are now being prepared. Okay, so this one's a little bit tricky, and I kind of hate to do this to you, but we know that cash is $624, but what's this contract liabilities here? Well, it is a liability, and that's really all we need to know to answer this question. But this is a type of what we call unearned or deferred revenue. Okay, so if you're looking for a deeper understanding of what's actually going on here, that's what it is. So we've got 1-year policy, right? And we can do this a couple of different ways. If it were me, I would take the 624 and I'd say, okay, that was for 1 year. 9 months is 75% of 1 year. And I come up with 468. Now I could also take 624, 624 divide by 12 to get me a monthly rate of 52 and then multiply by 9 months. And I'm going to get the same $468, right? Yeah. Okay. So with that in mind, let me move this out of the way here. So with that in mind, what we're going to do is, we already received the cash in the past, so we don't have to do anything with that. But what we do need to do is we need to recognize that we've had a liability that has gone down. Why has it gone down? Because of that $624, we've actually earned now $468 of that. So the liability has gone down by $468, and that's actually going to have a positive impact on earned capital. We can also now record earned revenues on the income statement of $468. We have no expenses to offset that, so net income would be increased by the same $468. Okay, we're getting there. Number 5, at the end of the period, employee wages of $965 have been incurred. There's that word again, but not yet paid or recorded. Not yet paid or recorded. All right. So what we need to understand here is that we can recognize the wage expense. We haven't paid it yet, so we're going to have to set up some kind of liability that says wages payable here. So it's, in this particular case, it's for $965, so the liability went up, and that's going to have a downward impact on earned capital. All right. We're on the income statement. Expenses have gone up by $965 because, again, we record the expense when it's incurred. I'm sorry, I put parentheses around that. Let's fix that right quick. $965, and net income actually would go down by $965. And then the last item that we have, it says at the end of the period, $300 of interest income has been earned, but not yet received. Well, this is ultimately going to be cash, okay? But we don't have the cash yet. We do not have the cash yet. So what we're going to do is we're going to increase a non-cash asset. Specifically, we're going to set up an interest receivable, kind of like an account receivable or a note receivable. Well, this is going to be interest receivable. So we have earned that $300. So not only do we have an increase in non-cash assets, we're also going to have an increase in earned capital because we didn't increase any liabilities along the way. Over on the income statement, we're going to have $300 of revenue. Now, I will say this, on a multi-step income statement, interest revenue is down at the bottom under other income. The only way it would be up at the top with the regular revenues is if we were using a really, really basic single-step income statement, and we don't normally do that. So regardless of where it is, whether it's at the top or the bottom, revenues have gone up by 300. Therefore, net income has increased by 300. All right, that's it for this video.